Hey everyone, welcome back to Invest IQ. If you're here, you're probably looking to get started with investing, and I get it. Investing can feel overwhelming, especially with so many options and strategies out there. But here's the good news. Today, we're breaking it all down into simple, easy-to-follow steps. We're going to cover 5 powerful strategies that anyone can use, even if you're starting with just a few bucks. No complicated jargon, no confusing charts, just actionable advice to help you build wealth. So whether you're dreaming of early retirement, financial freedom, or just want to make your money work harder for you, this video is for you. Let's dive in. Alright, strategy number 1, and this is crucial. Before even thinking about investing, make sure you have a solid emergency fund in place. This is the bedrock of your financial stability. Think of it like your financial safety net, a buffer that catches you when life gets unpredictable. You want about 3 to 6 months worth of expenses saved up. This might seem like a lot, but it's essential for your peace of mind. This way, if life throws you a curveball, like an unexpected medical bill, car trouble, or you suddenly lose your job, you're not forced to sell off your investments at the wrong time. You can handle these emergencies without derailing your financial plans. Having that emergency fund gives you peace of mind and protects your investments. It's a financial cushion that lets you sleep better at night. It's like building a strong foundation before you start constructing a skyscraper. Without a solid base, everything else is at risk. You wouldn't want your investments to crumble because of an unexpected expense, right? That's why this step is so important. That emergency fund is there to handle those situations and keep you on track for your long-term financial goals. It acts as a financial buffer, ensuring that your investment strategy remains intact. Trust me, having that cushion will make your investing journey a whole lot smoother. You'll feel more confident and secure knowing you have a safety net. Now, where should you keep your emergency fund? Accessibility is key here. You want it to be accessible, so a high-yield savings account is a great option. These accounts are easy to access and offer better returns than traditional savings accounts. These accounts typically offer a higher interest rate than traditional savings accounts, so your money can grow a little bit while it's sitting there. It's a win-win situation. The key is to have it separate from your checking account, so you're not tempted to dip into it for everyday expenses. This separation helps maintain the integrity of your emergency fund. Remember, this is your financial safety net, only to be used for real emergencies. Treat it with the respect it deserves, and it will serve you well in times of need. Now let's talk about where to actually invest your money once you have that emergency fund set up. This is a crucial step in building your financial future, and making the right choices can set you on the path to long-term success. And for beginners, my top recommendation is to start with index funds, or ETFs. These investment vehicles are designed to be simple and effective, making them perfect for those who are new to investing. Think of an index fund like a basket of stocks that tracks a particular market index, like the S&P 500, which is made up of 500 of the largest US companies. This means you're investing in a broad spectrum of the market, giving you exposure to a wide range of industries and sectors. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all those companies. This allows you to benefit from the growth of some of the most successful and stable companies in the country. What's amazing about index funds is they give you instant diversification. Diversification is a key principle in investing because it helps to spread out your risk. You're not putting all your eggs in one basket by investing in a single stock. Instead, you're spreading your money across hundreds of companies, which reduces your risk significantly. This way, if one company underperforms, it won't drastically affect your overall investment. Plus, index funds are incredibly low cost to invest in. They are designed to be cost-effective, which means you can start investing without needing a large amount of money up front. They have low expense ratios, meaning you're not paying a lot in fees to the fund managers. This is important because high fees can eat into your returns over time, and lower fees mean more money in your pocket over the long run. The savings from these lower fees can compound over time, significantly boosting your investment returns. Now, ETFs, or exchange-traded funds, are very similar to index funds. They offer many of the same benefits, including diversification and low costs. They also offer diversification and low costs, and they trade on stock exchanges just like individual stocks. This means you can buy and sell them throughout the trading day, giving you more flexibility. The main difference is how they're structured, but for beginners, both index funds and ETFs are fantastic options to get started with investing. They provide a solid foundation for building a diversified and cost-effective investment portfolio. Okay, so you know about emergency funds and index funds. Now let's talk about asset allocation, which is just a fancy way of saying how you divide your money among different asset classes, like stocks and bonds. The idea is to find a mix that aligns with your risk tolerance, time horizon, and financial goals. Generally, the younger you are, the more you might want to tilt your portfolio towards stocks. Why? Because stocks have historically delivered higher returns than bonds over the long term, and you have more time to recover from any market downturns. As you get closer to retirement, you might want to gradually shift towards a more conservative approach, increasing your bond allocation. Bonds are generally considered less risky than stocks, and they can provide stability to your portfolio as you approach your retirement years. But remember, this is just a general guideline. Your ideal asset allocation will depend on your individual circumstances, risk tolerance, and financial goals. If you're not sure how to determine your asset allocation, it's always a good idea to talk to a financial advisor who can help you create a personalized plan. Now, let's talk about one of my favorite investing strategies, dollar cost averaging. This strategy is all about taking the emotion out of investing and making it a consistent habit. Here's how it works. You invest a set amount of money at regular intervals, no matter what the market is doing. For example, you might decide to invest $100 every month in an S&P 500 index fund. When the market is up, your $100 buys fewer shares. When it's down, your $100 buys more. Over time, this strategy helps you average out the ups and downs of the market and potentially reduces your risk. The beauty of dollar cost averaging is that you don't need to be a market expert to do it. You don't need to worry about timing the market or predicting when to buy or sell. You simply set up a regular investment schedule and stick to it, regardless of what the headlines are saying. This strategy is especially powerful when the market is volatile because you're buying more shares when prices are low, which can potentially boost your returns over the long run. And finally, let's talk about rebalancing. This is something you should do at least once a year, or even more frequently if you prefer. Regular rebalancing ensures that your portfolio remains aligned with your financial goals and risk tolerance. Rebalancing is simply the process of adjusting your portfolio to make sure your asset allocation is still in line with your target. It involves buying and selling portions of your portfolio to maintain your desired level of asset allocation. Remember how we talked about asset allocation earlier? It's the strategy of dividing your investments among different asset categories, such as stocks, bonds, and cash. Well, over time, as your investments grow at different rates, your initial asset allocation can drift. This drift can expose you to more risk than you're comfortable with or reduce your potential returns. For example, let's say you started with a 70% stock and 30% bond portfolio. This mix was chosen based on your risk tolerance and investment goals. After a year, the stock market has a great run, and now your portfolio is 80% stocks and 20% bonds. This shift means your portfolio is now more aggressive than you initially intended. An aggressive portfolio can lead to higher returns, but it also comes with increased risk. Rebalancing helps you bring your portfolio back to your desired risk level. By selling some of your stock holdings and buying more bonds, you can return to your original allocation. In this case, you might sell some of your stock holdings and use the proceeds to buy more bonds, bringing your allocation back to the original 70-30 split. This process helps you manage risk and maintain a balanced portfolio. Rebalancing might seem counterintuitive at times, especially if you're selling an asset class that's performing well. However, it's a crucial step in managing your investment risk. But remember, it's all about managing risk and making sure your portfolio stays aligned with your long-term goals. Consistent rebalancing can help you stay on track and achieve your financial objectives over time. So there you have it. 5 simple yet powerful investment strategies for beginners. Remember, investing doesn't have to be complicated. By starting with these basic principles, you can set yourself up for long-term financial success. If you found this helpful, don't forget to like, subscribe, and hit that bell icon for more